we try and explain every day why the market's up by a couple hundred points, down by a couple hundred points. And Gabriella, it's almost always got something to do with the stimulus lately. You're kind of looking through all of that noise right now and say it's not a question of if there's going to be more stimulus. It's just a question of when, right?
Exactly. I think if we try to focus on the day-to-day movements of stimulus talks, we're going to get whiplash. So we should just look forward to where we're eventually going, which is we will get more fiscal support. It's a matter of when, not if. And beyond fiscal support, I think we're also in for fiscal stimulus over the next few years. There's just no appetite for fiscal austerity anywhere in Capitol Hill, honestly, anywhere in the world. Even the IMF has encouraged more spending by developed countries. So here, this is the kind of setup where we can get higher nominal growth, steeper curves, and a chance for cyclical sectors to outperform. We just need to get through the uncertainty first of the next couple of months and be positioned in portfolios already for that bounce we expect in cyclical sectors over the next few months, over the next few quarters.
Jim, you're sort of in the same camp. You're looking at the credit market, obviously, but the same thing. You say don't get too distracted by what's happening either with the stimulus talks or with the election at this point. You like credit. There's a lot of places that you see beneficial places for investors to be.
No, absolutely. And I agree with Gabriella. I mean, in the short term, there's going to be focus on, the size, the composition, the timing. But as Gabriella said, I completely agree. We are moving forward where there's an enormous amount of stimulus already in the market from central bank policy. You will in all likely see post the election some more fiscal stimulus. So when you look through over the next couple of years, we do think you'll continue to see a rebound in consumption. You'll see a rebound in investment from a corporate standpoint. And when you look through that on that recovery over the next couple of years, that dispersion that you've seen today, I think you'll see that grind with the recovery of a lot of these sectors as you see improvement with regards to testing, treatments, vaccines around the virus. And at the same time, some of these industries that obviously had a pretty severe downturn in 2020 start to recover. And when you look at the valuations in credit and equity, and you think about the excess returns that you're going to get, you're sitting in fixed income rates with cash near zero and even the 10-year at 70 basis points. I think equities and credit still look pretty attractive over the next couple of years.
Are you suggesting that people should get into some of the hardest hit areas, though, places like the airlines, the hotels, look at some of the credit offerings there?
I do. I think you have to be selective, right? I mean, obviously, the downturn is going to be extended for some of those industries, and some of the weaker structures or balance sheets or companies may have to go through some form of restructuring. But at the end of the day, I think some of these industries are going to recover, and I think there's value that you can find across a lot of different industries. And I certainly think, if you have the time horizon over the next couple of years, there are attractive valuations that you can find in some of these more distressed sectors.
Shepard Smith here. Thanks for watching CNBC on YouTube.